Okay, so can you guys see my screen? Yeah, okay. So, hi everyone. Welcome to October's Hoperation Fund monthly report. Um, so today I'm gonna start off with a fund report, some market analysis, finance and investment lectures, and then we're going to finish off with some free discussion. First of all, though, I would like to make some new announcements. The Hoperation Fund is currently seeking both student and adult advisors to join our team. You don't necessarily need to have a background in finance, but you do need experience in organizing student-led nonprofit initiatives. If you're passionate about supporting nonprofits and you want to make a difference, you are already qualified. So, um, so please contact us if you're interested in becoming an advisor for the Hoperation Fund, or if you know anybody like friends, family who might be interested and who might be qualified, feel free to reach out and email me. My second announcement is that we're also seeking fundraising ideas. So we're on the lookout for innovative and creative fundraising ideas. If you have any suggestions or strategies that could help us raise funds for our mission, we'd love to hear from you. So you can email me at the Hoperation Fund email, or you can just talk about it next meeting. Some examples of suggestions for fundraising are like reading or like a second reading club, yard sales, tutoring maybe. And my third announcement is that we are also looking for nonprofits to receive our donations. So, the Hoperation Fund is currently considering nonprofit organizations and projects that could benefit from our donations. So, if you know of such organizations or projects, please share your recommendations with us. We'd love to know so that we can donate the profits we got from the stock market to those charities. For more context, each year the Hoperation Fund donates 80% of its investment gains to various nonprofit organizations, focusing on, but not limited to, education in underserved regions and nations, the welfare of children and women, environmental conservation, animal protection, and student projects on STEAM and humanities. So if you have a charity in mind that's related to these topics, or maybe on a topic that you think the Hoperation Fund might be interested in, um, again, please email me or contact us. So now that we're done with those announcements, let's move on to talk about our investment portfolio. The return in September of the Hoperation Fund investment portfolio was 2.74%. Right now, the total capital is for the Hoperation Fund is about 17,618. And the total year to date of the Hoperation Fund is 35.5%. In September, we increased the shares of existing positions thanks to more cash inflow and capital. I also sold RSP and bought FXI, a Chinese ETF, ITB, a housing ETF, and IYT, a transportation ETF. My reason to buy FXI was that recent Chinese financial stimuli are expected to significantly boost the Chinese market. So the Chinese market might be positively impacted by that. For ITB, I bought it because the federal rate cut is a tailwind to the housing market, and the demand for housing still remains high. And finally, my reasons I bought IYT was that is that the early mid-expansion phase of the US economy can potentially strengthen the transportation sector. And so from this screenshot, you can see the three new positions we have now in the Hoperation Fund portfolio. And here is a chart of the diversification of the Hoperation Fund portfolio. You can take a moment to look at these. Note that the Hoperation Fund diversification, again, is pretty good. We are slightly more focused on technology though, like technology takes up about 50% of the Hoperation Fund's investment portfolio, but we do have many stocks in other different fields. And as always, here are some comparisons of the monthly returns of the Hoperation Fund portfolio, SPY, and QQQ. The return since the Hoperation Fund's inception is now 67.4%. Okay, so moving on to our market analysis, the market direction for now is bullish. The short term has changed from being bearish previously to now becoming bullish. The midterm is also bullish, and the long term again has stayed bullish. The market sentiment as of October 4th is now also pretty positive. So according to the CNN Fear and Greed Index, we talked about the CNN Fear and Greed Index last time. So this is a number from 0 to 100, where 0, or the closer to 0, the more fearful the market is, and the closer to 100, the more greedy the market is. So right now, the Fear and Greed Index is 74. So this is right between greed and extreme greed. So right now, the market is very positive. The recommended position size, um, as of now, I feel like um, it would be good to hold a much larger portion of stocks. And I would recommend holding bonds for now, but not buying any new ones. And I would recommend starting to accumulate commodities. The market valuation as of October 4th is now as shown here. The S&P 500 PE ratio is 30.02. So the previous PE ratio was 38, so that was very high. Right now, the PE is still on the higher side, in my opinion. The 10-year Treasury yield is also 3.969%. Okay, so does anyone have any questions so far? Okay, great. So now moving on to this graph here. This shows the stock market and the economy in like an ideal situation. Like it's not going to always be like this, but generally, um, you can see the stock market is a leading indicator of the economy. So when the stock market goes up, after a while, the economy will go up. When the stock market goes down, after a while, the economy will go down. So right now, where are we in this like stock market or this economy? Right now, we're about in a medium bull market. You can see, and right now our economy as of now is just beginning to recover from its previous recession. So this is a pretty positive signal. And also, from these green boxes here, these show the 11 sectors. Um, the green boxes for each period of time or for each like stage of the market, the stock market and economy shows the best sectors to invest in. So right now, I would recommend investing in the technology sectors, the industrial sectors, and the basic material sector. Okay. Now moving on to seasonality.
Oh, can you go back a slide? I want to take a picture of it real quick.
Okay, sure. Also, there's going to be a recording of the Hoperation Fund like meetings, so you can always like feel free to watch that. Oh yeah, it's best now to invest in these sectors to answer your question, Leo, because these sectors, like from statistical data like compiled over time, these sectors are shown to have the highest returns. Um, Also, these sectors tend to do well when like the economy is like just recovering from a recession and when there's going to be like a medium bull market. Yeah, no problem. Again, if anyone has any questions, feel free to like type them in the chat or to just ask them. Sometimes I might miss them in the chat though. Okay, so moving on to seasonalities. From this graph, you can see there's a periods of times. There are like periods of times in October. Take October 1st to October 6th, for instance, and the statistical returns since 1950. So these are like the average returns over time or over these years. Um, Here you can also see the S&P 500's average monthly returns since 1950. Um, for all other years, plotted here in this blue, you can see here, but for election years, and I think 2024 is going to be an election year. So for election years, it's quite different though. So again, this seasonality pattern might not be the most accurate, so I wouldn't recommend like fully trusting this seasonality pattern graph or table because usually in election years the returns are quite different from normal years. So this is just something to like look at and to just be interested in. Okay. So next, let's go on to our investment lectures for today. Today, we're going to review a bit of the investment lectures for last that we did last time. Then we're going to talk about the volatility and risks of stocks, exchange traded funds or ETFs, um, market indexes and index ETFs, the S&P 500 sectors and sector ETFs, and the business cycle and asset allocations. Um, I don't know if we're going to have enough time to cover all of this though. So if we don't have enough time, um, we can discuss this next time or next meeting. Okay. So here's just the review from last time's lecture about the compound effect. Um, you can see from this story or this visualization, we have two investors, investor A and investor B. Investor A starts at age 25 and invests $5,000 per year for 10 years, so investing $50,000 total in the stock market. He has no extra investments though after the age of 34. Investor B starts at age 35. So now this is age 35 instead of age 25 and invests $5,000 per year from age 35. This picture had a typo. So from age 35 until age 65. So about 31 years. Uh, so who ended up with the most money? Of course, it's investor A. As we talked about last time, again, investor A invested earlier, so he had more time to let his investments grow. This example shows that time is on your side when you invest in stocks, and the earlier you start, the longer your investments can work for you. Um, from this example, we can see that it's important to invest the earlier or younger you can. That's why right now, um, if you're like 11, 12, 13, 14, it's important to invest right now. So in the future, you will have a lot more money. So talking about investing in stocks right now, let's go on to the rest of the lectures today. Today, we're going to be learning about the volatility and risk of stocks to like mentally prepare you and so that like you know about the volatility of the stock market. Before we learn about the volatility of stocks though, it's important to be able to search your stock up and at least check its basic data. So if you go to Google, although maybe not right now, but if you go to Google and you search up a stock, say Apple, or if you type in its ticker symbol, you will get this. So you will get approximately this. Um, Here you can see the graph of Apple and various different basic data and stuff. So first, what you might see is under its name here, you might see its ticker symbol. So this is basically, it's basically its name in the stock market. You will also see a lot of words here and maybe some words you might find in stock market reports or anything. So one of the words might be after hours. What after hours is, it's basically the time after the stock market closes. So the stock market is open on weekdays from 8 a.m. to 3 p.m. You can like trade freely from that time. After 3 p.m. though, the market basically closes. You can still trade after that time, but with limit orders, and it's called after hours. So after hours was created basically for the convenience of like working people during the day because they can't easily access the stock market in their jobs. Um, Open, high, and low. Opening open is the opening price of that stock that day. High is the highest price it it got to that day, and low is the lowest price it got to that day. Market cap is basically the price of the stock multiplied by the number of shares that stock the company has. So it's basically to see how large a company is. The P ratio is the price over equity ratio. We've talked about this many, many times before. It's basically like an uh, indicator or a valuation of or like a ratio of the valuation of a stock. The dividend yield is in percentages the number of dividends a stock yields. So a dividend is like the money a stock gives you each month or after a period of time if you buy it. So if you want to calculate the money in dollars a stock gives you for dividends, you can multiply the dividend yield by the stock price. And finally, the 52-week highs and lows are basically the highest price and the lowest prices the stock has reached in 52 weeks or in 1 year. Okay, so does anyone have any questions so far? Okay. So let's move on to talk about the risks of stocks. Individual stocks often exhibit high volatility, which can cause anxiety and fear for many investors. During periods of significant market fluctuations, it is common for people to sell their stocks to incur losses. Take NVIDIA, for instance. Here is the graph of NVIDIA. You can see it looks pretty good, right? It's nice, it has steady earnings, there's a bit of volatility here and there, but it's like tiny dips, right? Right? It turns out these tiny dips, they actually result in huge losses. If you look closer at the scale of this graph, you can see that it's not as simple as it looks. Take this period of time, for instance. Um, the highest point was around 10-ish, and the lowest point was around $2. It looks small, but actually the drawdowns are huge. Here, the drawdowns for NVIDIA from this graph can reach up to 80–90%. As you can see, this tiny dip, as mentioned previously, actually was a dip of around 90% of NVIDIA's price. 90%. So if you are holding a stock and it suddenly went down 90% from 10 or so dollars to 2 or so dollars, that would cause like huge panic, right? You would have like extreme panic because those would be like huge losses, huge percentages. And while on paper it might seem not so big, it might seem very simple. In real life though, those drawdowns are huge. Even the smallest one here is about like 30%. So I'll give you guys a moment to look at um, these like graphs and compare this with the actual drawdowns. Mm. Okay, so from this example here, you can see how volatile and risky stocks can be, even stocks that might perform really well, like NVIDIA. So, stocks are even more volatile, or it might be even more scary if you only hold one stock in your portfolio. If you only imagine if you only held one or two stocks in your portfolio, if they went down by a lot, you would be terrified because it's really scary if your portfolio suddenly goes down by 80–90% at a time. That's why it's important to diversify your portfolio. Um, we will also talk about that in later lectures. It's very important to um, have multiple or many stocks in one portfolio so that when one stock goes down, your entire portfolio doesn't go down. So talking about losses, you also need to keep in mind it is very hard to recover from a loss. From this visualization here, you can see if you lose 1%, you will need to gain 1% to go back. If you lose 5%, you will need to earn 5% on that to recover and go back to your previous capital. But as you lose more and more, you will need to recover, or you will need to gain even more to recover. For example, a 30% loss on a stock requires a 43% gain to recover. A 50% loss on a stock requires a 100% gain to recover. For example, $100, if you had $100 in a stock, if you lost 50% on that stock, the stock's price would be $50, right? But on that $50, you would need a 100% gain to go back to your original $100. That's why it's very important to try to minimize your losses sometimes because it's very, very hard to get out from a loss, especially a huge loss, like a 50% loss. You will need to um gain a lot of money or a lot of other um you will need to have a very high gain in order to go back to your previous capital. So individual companies can face challenges such as business cycles, industry cycles, management changes, product recalls, legal issues, or competitive pressures that can negatively affect stock prices. A company that is a market leader today may become a dog, or it may become outdated and may have very little returns in the market after a few years. So, an example is Boeing or BA. You might have flown on its planes before. You can see from its graph here that in 2017, 2018, 2019, 2020, it was a pretty good company. It was growing. Right here, it has a little bit of a plateau, but like it was still a pretty good company generally. But in 2020, suddenly, it went from $350 to $100 or so. Imagine the loss from that. And it wasn't because like Boeing split its shares or anything to cause like the prices to go down. I think there was some sort of accident with one of its planes, the a Max something, and it turns out one of its planes had like huge issues. So all of a sudden, a good growing company at a price of around $350 went from here to here. You can see it, the massive like decrease or loss in prices it would have had. And keep in mind, this is just in around 1 month or less than 1 month. From this example, you can see how like volatile stocks are. They can go from growing to suddenly go down steeply and have like huge losses. And you can see from then on, like Boeing didn't really recover. Um, it's somewhat recovered here, but from then on, it just had like medium, kind of mid price or returns. So this accentuates this accentuates the idea that again, stocks are very risky. Like they can bec go from becoming a market leader to becoming one of the worst in its market. And of course, these examples are pretty negative. They're not meant to be like extremely like damaging to your self-confidence or anything, but they're just to tell you that again, to tell you that um stocks are very risky and that it's important to diversify your stocks. And even then, you will still have some risks in the stock market. Like emotional preparation, you know? There So as said before, there are lots of other risks if you're holding one stock in your portfolio. Maintaining a portfolio of about 15 to 20 stocks is recommended to achieve an optimal balance between risk and return. From this visualization here, you can see on the y-axis is the average annual standard deviation in percentages. Mm. The red section here shows the diversifiable risk. So the risk that can be decreased if you diversify the number of stocks you have in your portfolio. And the blue section here is non-diversifiable risk. So generally, as you have more and more stocks, and maybe like more stocks in like different sectors, you will have less of an annual standard deviation or less risk. However, at some point, you will still have some amount of risk, right? Because the stock market is always going to be risky. But this blue risk, this red risk, this can be decreased a lot by having around, I would say, 10 to 20-ish stocks, preferably. Mm. And this is exactly why exchange-traded funds, or ETFs, are so popular. An ETF can be viewed as a basket of a number of stocks. ETF share prices can fluctuate all days as a regular stock does. And like stocks, ETF shares can be bought or sold all days. So generally, the asset manager of an ETF constructs the ETF with some purposes, such as tracking a particular market index, a market sector, or a thematic index, such as clean energy, AI, electric vehicles, etc., or a strategy. From this graph here, you can see the ETF SPY tracks the S&P 500 index. XLK tracks the technology sectors of the S&P 500 index. ICLN tracks the performance of approximately 100 clean energy-related companies. ASHR tracks the CSI 300 Chinese A-shares index. And SHY tracks the investment results of an index composed of U.S. Treasury bonds, with remaining maturities between 1 and 3 years. So these are examples of ETFs. You can see that each ETF has some purpose, like it tracks an index or some kind of field or sector, or it's based on some sort of strategy, right? So now before we move on, I can just stop here. Does anyone have any questions, or does anyone want to review a slide? Okay. So one type of ETF, a market index, tracks the performance of a specific basket of stocks that represents a particular market. So examples of this include the Dow Jones Industrial Average and the Standard & Poor's 500 index. You cannot directly invest in these indexes, but you can invest in ETFs tracking the indexes. So the Dow Jones Industrial Average, this is an index. It is a stock market index that tracks 30 large, publicly owned blue chip companies trading on the New York Stock Exchange, NYSE, and NASDAQ. The index is a widely watched benchmark index for US blue chip stocks. So a blue chip stock is a nationally or internationally recognized, well-established, and financially sound company. Blue chips generally sell high-quality, widely accepted products and services. So the Dow Jones Industrial Average, DJIA, the components of this change as the economy changes. So a component of this index can be dropped when the company becomes less relevant to the current trends of the economy, or it becomes like old, or the returns aren't very high anymore, to be replaced by a new one that better reflects the shift. For example, a company may be removed from the index when its market capitalization drops because of financial distress or financial problems. The index value can be viewed as a simple average of all the 30 shares' stock prices. So stocks with higher share prices are given greater weight in the index. Here is a screenshot of like the DJIA top holdings as of October 3, 2024. So you guys can take a moment to look at this. Um I think Leo also asked a question to me. So how come the stock goes down by 50% and you have to have a gain of 100%? Oh, hold on. Yeah. So the reason for this, yeah, and thanks for asking that question because maybe like other people might also have might also have had that question. So let's say you have a stock that's worth $100, right? Its price is $100. When it goes down by 50%, the price is $50. So if you want the now $50 stock to be worth $100 now, it needs to have a 100% gain to recover. So say, oh wait, huh, this is weird. Okay. Okay, so say you have a $100 stock. If it goes down by 50%, you will have like a $50 and then it will need to go up by 100% to get $100. Yeah. So this example just hold on. How do Okay, this example just shows like how hard it is to recover from a loss, right? So you need to again like besides focusing on having really high gains, you also should try to minimize your losses. I think Warren Buffett had a quote before that like a 50% loss in the stock requires a 100% gain to recover it too. Okay, so does anyone have any questions? Okay, so Heidi asked if Nvidia is a good stock to invest in and how much should I put in per month? Like for a portfolio or I put like money in per month? Or for a portfolio, like how much it takes for a portfolio? Okay. So I feel like Nvidia itself is like a pretty good stock to invest in. Um, um, Depending on what percentage of it you should put in your portfolio, I would recommend it depends on like what you want your portfolio to be. Like if your portfolio specializes in like growth stocks, I would recommend maybe putting a little bit more in of Nvidia in your portfolio, like um 7 to 10%. Generally, I would recommend for like a usual portfolio, I would recommend like 5 to 10% or less if you have like less confidence in Nvidia. As I said before, you should maintain a portfolio of about 10 to 20 stocks. Um, like I would recommend to have like a stable portfolio. Mm, so I would say about 5 to 10%, 5 to 7% maybe. Yeah, yeah, no problem. Does anyone else have any more questions? Okay. Tomorrow. Okay. So now we're talking about like market indexes, right? Oh, what is an ETF? Oh yeah, that was what we were just talking about that actually. So um an ETF is like a basket of a number of stocks. So it isn't exactly a stock itself, but it contains like multiple stocks. It's very popular because like if people want more diversification or if they want some stocks that specialize in a particular sector. For example, SPY and QQQ are ETFs. SPY tracks the S&P 500 index and QQQ tracks the Nasdaq 500. Wait, Nasdaq 100? Well, QQQ tracks the Nasdaq index. Um, mm, Speaking of which, if you guys have like any like particular questions you want to ask me about stock recommendations, you guys can like feel free to ask me like after class. If you can like email me or something because sometimes during like did I say class? Okay, during these meetings, sometimes I won't like give extremely like specific details on a stock, and also some stocks maybe if you want to ask me like if they're a good stock or not, I can outside of this meeting I can do research about that stock and tell you sometimes. Yeah. So, anyways, about ETFs, again, they're like a basket of a number of stocks. They are composed of many different stocks that are based on some kind of purpose. So, for example, DGIA is um a ETF. The S&P 500 index is also the SPY is an ETF. It tracks the S&P 500 index. So this index features 500 leading US publicly traded companies. These companies can be categorized into 11 sectors, such as the technology sector, healthcare sector, energy sector, finance sector, industrial sector, etc. It is widely considered one of the best gauges of stocks of large US companies and even the entire equities market. The S&P 500 index has strict criteria to include companies of good quality in the index and to drop companies not meeting the criteria. So this index is market capitalization weighted. That means the larger a company's market capitalization is, the more weight it has in the index. Mm, Here you can see this is like a visualization of the different sectors of the S&P 500 index. The many companies composing it, like the bigger a company's block is, the more capital the more percentage of capital or size they take in the portfolio. And yeah, you guys can take a moment to look at that. You can see SPYs or like the S&P 500 index is really like a basket of stocks, right? There's many different stocks. Actually, I think listed here are just some of the 500. Okay, So some other market indexes are like the Nasdaq. Oh yeah, Nasdaq 100. Yeah. So the Nasdaq Composite Index, which is a market capitalization weighted index of more than 3,700 stocks listed on the Nasdaq Stock Exchange. It is a broad index that is heavily weighted towards the technology sector. Mm. The Nasdaq 100 index is also a basket of the 100 largest, most actively traded US companies listed on the Nasdaq Stock Exchange. It is market capitalization weighted and includes companies from various industries such as technology, retail, biotechnology, industrial, healthcare, and others. It doesn't have any stocks from the financial industry though, for some other complicated reasons, but yeah. Um, so here, you can see the SPDR, Dow Jones Industrial Average. You can see, the Dow Jones Industrial Average ETF Trust here. Um, this is the actual Dow Jones Industrial Average. But it's very expensive, you know. Here is like an ETF trust. It's slightly less expensive, so it's better for like the common like the general person, you know, to invest in. That's why like these ETFs are more convenient. Um, you can see they have like the same returns. Like this is like 27.88%. This is 27.85%. So this has similar returns to like the actual like um maybe what the index actually might have been like, but this is like slightly like on a smaller scale. Okay. So this is actually most of the content I will cover today. I think I have a little bit more actually. Uh, yeah, I do have a little bit more details about sectors, but I will just talk about that next time. Next meeting though, for now though, does anyone have any questions or something they want to ask me? We can like discuss the stock market right now. Okay, does anyone else have any questions about like today's material or wants me to backtrack a few slides? Yeah, again, sometimes in some slides I might talk a little bit quickly, so it's okay if you want me to like go back a slide or like repeat some information sometimes that might not be too clear. Hmm? Oh yeah, thanks, Laura. Laura, yeah, thank you. Um, again, yeah, these like Hoperation Fund monthly reports and meetings, these are just for mostly I put all my investment knowledge into this, and it's like really inspiring to like do this, like discuss like investment knowledge with you guys. So I'm really glad you like this. I hope you've so far learned a lot from these meetings. Yeah, great. I would love if your dad becomes like an adult mentor. Like again, we're looking for new advisors, and I'm sure your dad, because he seems very qualified. He seems like um he would be a great adult mentor. Yeah. Okay, so does anyone have any questions anymore about this? If not, since a few of like the other material from this report we can cover next meeting. because next meeting we're going to be discussing more in depth about like sectors and stuff. So does anyone have any questions about this? If not, I guess this is today's meeting then. Yeah.
Thank you.
Yeah, no problem. Thank you all.
Yeah.
Thank you.
Thanks.
Thanks.